I have published two new blog posts discussing my trade since my last video. The last one was published on August 18th, 2026. A link to my blog post can be found in my profile section. Here at YouTube, I am currently publishing new posts on Tuesdays. I've been publishing posts since October 2008. I have discussed many times in my blog post how I attempt to manage interest rate risk in my bond portfolio. I'm going to summarize those earlier discussions in this video. This topic has become more important with yields persistently rising since the start of the Iran war, with the 30-year Treasury hitting a 19-year high earlier this week. Mortgage rates have been trending higher as well since February 2026, with the average rates for the 15 and 30-year mortgages tracked by Freddie Mac in its weekly surveys and those are published at its website. The average 15-year mortgage rate was at 5.44% for the week ending on February 26, 2026, just prior to the start of the war, and was at 5.96 for the week ending August 20, 2026. When the next survey is released for the week ending August 27th, I'm expecting the rate to go over 6%. The first method that I use to address interest rate risk is to use a bond ladder approach where I have bonds and or treasury bills maturing each week. This works better when interest rates are in an uptrend as they are now. My interest income will be higher in 2026 and 2027 based on what I've already done than it was in 2025, which was a good year compared to what happened during the extended period when the Fed was suppressing interest rates with its ZIRP and QE monetary policy. The second risk mitigation strategy is to have a weighted average duration that is short term, and mine fluctuates in the 2 to 3 year time period. Buying treasury bills at auctions and to have a constant flow of corporate bond redemption proceeds tends to anchor the duration in that 2 to 3 year time range, even though I have corporate and municipal bonds with longer maturities and some much longer maturities. Another risk mitigation technique is not to place myself in a position where I have to sell bonds at an inopportune time, and those will occur, to pay expenses. That is a potentially adverse result flowing from a persistent rise in yields that cause the lower yielding ones, the vintage ones bought it with lower yields, to go down in price. With rates still low from a historical perspective, and of course I remember when the short-term rates were over 15% in the early 1980s, it does not take much of a rise in interest rates now to wipe out the income generated by these lower yielding bonds and treasury bills and treasury notes, and enforced selling can easily result in a negative return, and much worse when adjusting the return for inflation and taxes paid on the interest payments. For the interest rate risk, for me, it just boils down to what I call the risk of lost opportunity, meaning I lose the opportunity to buy higher yielding bonds with funds tied up in lower yielding ones, and I would not be exercising the option to sell at a loss those bonds to buy ones using the proceeds that have a higher yield. I just wait for all of them to mature. It is important that I own individual securities that have a maturity date where I have the option of holding to the bond until it is redeemed at par value. Now, I will trade the longer term bonds. I mentioned in my blog post that I traded 132 corporate bonds last summer in 2025. that I had bought earlier that year and recognized over a $3,000 profit. But if I go into those trades expecting to and hopefully selling them at a profit without a long holding period. But if I get stuck, I can always hold them until they mature. They also limit the number of bonds and treasury notes that I buy in one purchase. A typical corporate bond order is just one or two $1,000 par value bonds. But I may end up buying 5 or 10 of the same bond as the rates become more attractive. The bond price goes down, I may buy more. I bought one Treasury note today maturing in 2031 at a lower price than the two I bought at auction recently. And that was a 5-year Treasury auction. If the price continues to decline for that 2031 Treasury note, which I think had a 4.125% coupon, I will buy one more and so on. I noted in a comment to my last blog that Besant's Operation Twist announcement was too small to have a lasting impact on longer-term Treasury yields. Increasing the size of a purchase operation to $4 billion from $2 billion when there's over $40 trillion in U.S. government debt that's rapidly expanding is not going to move the needle much. When carried out by the Fed in the past rather than the Treasury, and this has been a Fed policy that they've performed many times in the past, the operation involves selling short-term Treasury bills or notes owned by the Fed and using the proceeds to buy longer-term Treasuries. Studies of those earlier operations indicated at best a minimal short-term impact on long-term yields. The problems causing the rise in longer-term yields are not solved by this kind of operation, and the result may end up being harmful to the U.S. balance sheet when and if the longer-term treasuries that are sold have basically lower coupons than what the Treasury has to pay refinancing the Treasury bills, the excess Treasury bills used as a funding source for the longer-term Treasury purchases. So that's just a brief summary of some of the ways I try to manage interest rate risk in my bond portfolio. Prior to 2007, I didn't own a bond. I don't think I'd even bought a bond prior to then, but I have transitioned in my old age here to focus more on owning bonds than stocks.